Welcome back to the Trading Desk. Dave, you and I were talking a little bit about the broader markets and the S&P 500. We've had a big sell-off. We've sold off almost 80 points, or 7.5%.
Right.
From
the beginning of the year.
From the year highs. And again, we were talking a little bit about, most perceptions, again, such a powerful 9-10 month rally, really 10 month, when you look at most of the rally went through January 20th. Now we're at a point where people are, again, deer in the headlights, and we should talk about this a little bit because most people don't plan for these pullbacks, or they're not thinking about. And this is something, I interviewed you last week for my blog, and we talked about, planning. And seeing down the road, good, bad, ugly, you have to have a plan all along. So let's talk about this a little bit because we're at, people weren't coming into this year expecting pullback.
Right. And if they were thinking maybe buying opportunity. And I think pullbacks are good buying opportunities under the right circumstances. I happen to be of the opinion that I don't know if this is going to be a long and sustained drop. At the very least, I don't think the S&Ps are really going to do anything this year.
I came in, my prediction, if you put us into the prediction camp, again, last year was, we'll trade between 1,000 and 1,250.
Right.
Nowhere.
And that's going to be next to impossible for an investor to make money in.
Right.
And I think what's key is that what's different perhaps this time, and I hate to use that because everybody always says it's different this time, but what is different about this is this rally that we had last year was basically due to interest rates going to essentially zero. The economy did get a little bit of a bounce, but again, I don't think there's any real solid footing under that. We're starting to see very sporadic economic data.
Right.
I don't think this. I think the market's probably overpriced on some level, and of course, technically, we're breaking down. So I think it's really important that people don't look at this as a buying opportunity. They probably should look at it as an opportunity. If you were fortunate to be long in here, start locking in some gains.
Yeah.
Again, there's nothing wrong with cash.
A little bit of cash here, absolutely.
Yeah.
And again, the Keynes model. People who believe in the Keynesian methods of government intervention are very positive here, but I'm more on the Mises, the Austrian economic side, where maybe that it was too much intervention because it hasn't really seeped down into the small business, and now Obama's talking about putting $30 billion of the TARP money towards the small business. Right. Listen, it's just another Band-Aid, and again, bigger government is not the answer here. Bigger bureaucracy is still not the answer to our problem. So I'm not a fan, and this is not, again, the policies are the same policies that the Bush administration had in place. So this is not a political stance, it's the same.
It's knee-jerk reaction. There's never any forethought. I think what viewers at home may want to consider, if you're looking at your portfolio, and if you are inclined to be more trading-oriented, maybe a multiple week, multiple month view, the SDS, which is the ETF that goes up in value as the S&Ps go down.
Right.
I think that's something you need to consider. And you and I both agree. I think in the next few days we're probably going to get a decent rally in the S&Ps.
Yeah.
That'll pull the SDS back. Be buyers, and I'm going to talk about that later in the show. It's my pick come fantasy finance. So,
and again, I don't see the next quarter us going to new highs in the S&P 500. I don't see that happening. So look, and if that happens, we'll adjust accordingly. But unless we get over 1150, I don't see us, going to
So unless the economy improves dramatically, and the fact that the Fed is actually at the point now where they may not raise interest rates, but they're certainly not lowering them, that's a pretty big headwind for the market. So I'm not terribly interested. Why don't we move on to gold? And again, we talk about the same broad themes because nothing dramatically changes from show to show from a longer term picture. But I pulled this chart up today again to appease more to the trading oriented viewer. This is actually a chart of gold. And it's an hourly chart, so it's only showing maybe back about a month.
20 days, 20 days
worth
of trading.
Of price action. And what I think is really key here, I think gold is due for a bounce, as are the S&Ps, and I think the dollar is going to pull back just a little bit. What I would suggest to viewers at home possibly is if gold rallies into these Fibonacci resistance levels, it might be a good opportunity to buy DGZ, which is the ETF that goes up in value as gold goes down in value. So the point I'm trying to make is I'm trying to get our viewers at home into the ebbs and flows of the market.
Yeah, the inhale, exhale. This is natural in the market. You get the inhale and exhale all the time, and this is where traders make their money. Same thing, we both agree that we're bullish dollar macro, big picture, but it's going to pull back here. It's just run too hard. It's running up to some price levels at 90 that have some serious resistance. We'll pull back. You'll also see with that commodities bounce a little bit. Gold being one of those commodities. So gold will bounce, wheat will bounce, corn will bounce. But these bounces, you could play them for the bounce, but then I would also set up, okay, now I want to start getting short again. So you can play it both ways, or you can just wait for the higher price and come back. So when we come back to the trading desk, we're going to talk more about some trading ideas and the macro versus micro and how you can benefit from those types of fluctuations.